I think what's interesting is that even at 1,700 gold, there are a lot of projects which make good economic sense.
The large caps are and the mid caps are still shying away from M&A, at least openly. And I think that'll have to change, and some of them will. When some of these companies start taking those bites, it'll start a flurry of activity that we haven't seen in a while.
Throughout 2020 and 2019, we saw outflows from the GDX and GDXJ, and yet gold hit all-time highs. And it really doesn't take a lot to have a small shift in sort of investor or asset allocation to move the gold space.
There's going to be a big shift in how are companies able to sustain 5, 10, 20-year periods of time in good markets and bad markets. And I think there's a different sort of audience in terms of there's stuff that's going to be really, really fun if gold and silver is doing well, and there's going to be businesses that you're going to be able to have larger positions in those because they can navigate both cycles.
From what we've seen from the COVID bust in March of last year, is precious metals leading, and now the rest of the commodity complex catching up. And I don't think that's too bizarre of a phenomenon in terms of what we've seen in past cycles. And it stands to reason that at some point here, this consolidation phase amongst the precious metal equities will come to an end, and we'll commence our next leg higher.
Well, hello viewers, and welcome to One-to-One Mining Investment Americas. Today, we're going to be focusing on some of the most pressing issues regarding gold and precious metals mining investment. I have with me a superb panel of investors and finance professionals. I'll introduce in turn. I have Coille van Alphen, Senior Analyst at Equinox Partners, Peter Maletis, VP of Merk Investments and President of ASA Gold and Precious Metals Fund, Matthew Geiger, Portfolio Manager at MGJ Capital, and Chris Mancini, Portfolio Manager at Gabelli Gold Fund, and Chris Ritchie, President at SilverCrest Minerals. So everyone, very warm welcome, and thanks for joining me today. I wanted to start with trying to make some sense of what's happening in the market at the moment. The gold and silver price and precious metals equities have seemed to have had a sort of correction over the last 6 months or so, and I just wanted to get the panel's view on perhaps why this is and where they think the market could be going at the moment. And Peter, could I turn to you first, as you're, this is the first time we've had you speak for us, and I just wanted to get a quick introduction, if you can, of Merk and the ASA Gold and Precious Metals Fund, if you don't mind, and then take on that opening question, please.
Sure. Yeah. So I've been managing the ASA Gold and Precious Metals Fund for about 2 years, actually almost exactly 2 years as of yesterday. And it's a $500 million US closed-end fund focused on precious metals. And prior to that, I spent 9 years working at Franklin Templeton as the precious metals analyst and covered all the different mining. And so I spent a lot of time traveling all over the world, looking at assets and talking with management teams and analysts. Traveled with a number of people on this panel, and so made a lot of good connections over time. As for the current market, we had obviously had a really good run over the last 2 years, but the last 4 to 6 months have been a little bit volatile in terms of, and I think the gold price in general is trying to find its footing, and but it's there's a lot of tailwinds that have the potential to push the gold price higher. That being said, there's also different elements of headwinds, in terms of like the Bitcoins of the world and other parts of the economy that are trying to, people trying to make good sense of as we come out of this COVID period. That being said, the larger companies are doing some of their best work in terms of managing production levels, managing costs, managing the balance sheet. And a lot of the smaller cap exploration and development companies are doing a really good job of managing exploration potential and putting out data that really is supportive of the entire kind of complex. So, I think, fundamentally, I think a lot of these companies are as good at positions as they've ever been. And it's really just relying on the gold price to kind of support where we're at.
Yep. Okay. We'll come back to dig into some of the company's performance in a minute, but could I just probe you a bit more on in terms of the state of the markets. We might be waiting for gold price to come back, but do you think that the conditions are ripe for it to come back? We've had this excessive period of monetary printing. The stimulus seems to still be going on, although we're going to be coming out of the pandemic. The grants, certainly here in the UK, I don't know about North America, the grants for businesses are going to be pulled back. It's going to create a riskier period again, one would have thought, in terms of the macro picture. Surely this is all positive for gold. Can we see the price, rising up again this year?
I'm down here in the U.S. and the government is really sort of getting their foots around what they're doing. It seems like the stimulus packages will continue, and that there's a potential for infrastructure spend that is all very supportive of the gold price. And then the additional inflation picture seems to be getting better, which is something that we need to pay attention to, because inflation and a lot of different commodities and services seems to be going up pretty significantly and pretty quickly. So it'll be interesting to see how the government reacts to that. But I think that's all very supportive of the gold price as well.
Yep, certainly. Coille, could I turn to you now and get your view from Equinox? Since we last spoke, how are you making sense of how precious metals markets have gone?
Sure. I'm in Canada, but the fund is based in Connecticut. And I think there's a difference between fundamental investors that are sort of looking through the short-term stimulus. But I think from the general markets, we just had $1.9 trillion injected into the market. And people are, the vaccine rollout is going quicker than expected, and sort of the safe haven assets are getting sold off, and sort of the stocks that you'd expect to do well during sort of a reopening are happening. But that's great for a quarter or two. But I think if you look through that, once potential stimulus slows down, and the backdrop of what's good for in the gold price, particularly to Peter's comments about inflation, I think are all positive. But that's a few quarters away, from my perspective.
Yep, certainly. And in terms of the equities and some of the sort of a broader correction, I guess, in some of the gold and precious metals mining equities, do you see that just as a lag following what's happened to the gold price, or do you see that as some of the heat coming out, maybe moving towards this green agenda that seems to be going on, green stimulus that's made some of the other mining stocks perform well towards the end of last year, for instance?
I think, I pulled this up before this panel, and the gold price is oddly enough sort of exactly where it was 12 months ago for very different set of reasons, but the valuations look essentially the same on a price to cash flow basis. The difference is the producers had a year to print a lot of cash, and so the seniors are in a much better position fundamentally. Their balance sheets are a lot stronger, net debt's a lot lower, and their valuations are kind of unchanged. So I think it's a lot more driven by the gold prices as opposed to a shift to greener alternatives. There's definitely ESG is becoming a bigger piece of the puzzle. You look at Newmont last night, who announced they're doing a $3 billion revolver based on their ESG score. It's something it's alive and well in the gold space as well, and they can certainly compete with the best of them on ESG practices.
Yeah, certainly. Let's dig into those ESG elements in a little bit. But do you think then that companies are undervalued if we've gone back to perhaps valuations of where we were 12 months ago?
Well, and valuation and price to cash flow are roughly the same, but the dividend yields are even better. So, a lot of the seniors and intermediates have increased their dividends. So, to me, they're in a much better position than they were 12 months ago and at the same price. So, to me, I'm very comfortable owning these guys through the cycle.
Yep.
They've also shown that they're quite disciplined. That was a big question for investors 12 months ago. It's like, are they going to go do M&A? And they didn't. They sort of were very conservative and managed those expectations quite well, I think.
Yeah, certainly putting to sleep some fears or anguish of repeating what happened in the last sort of 2011 cycle. Okay, great. We'll come on to some M&A discussion in a bit as well. Matt, could I bring you in here for your interpretation on where we're at with the markets in this broader correction and some of the things that our peers have said?
Right. Well, I think folks listening to this need to keep in mind that just 7 months ago, we were literally at all-time high gold prices. And, this is what happens in bull markets. Prices go up and they correct for a certain period, and then there's further legs. So I'm still fully of the view that we are in the midst, early to mid stages of a long-lasting precious metal bull market. View this as a healthy consolidation period. And if you look at the prices of physical gold, physical silver, we're off roughly 20% from where we were in the highs of this cycle. So to me, that's not too crazy at all. Those of us that have been in this space know that a 20% move in the metal price in any direction is not an anomaly whatsoever. So I think we got to take a pause here. Keep in mind where we are in the cycle. Obviously, there's these narratives out there that are percolating in terms of why this is occurring. There's the first kind of reopening roaring 20s argument that the time for precious metals was last year in the aftermath of the panic, and now the economy is opening up and it's going to be all roses from here. And then the second argument is that Bitcoin and some of the cryptocurrencies are stealing the thunder from precious metals, and that could be a longer lasting trend. Personally, I mean, those narratives will persist until they don't. I think I could poke holes in each of them. I think the economic reopening argument is reasonable in some respects, but folks also have to keep in mind that we've muddled through this through insane monetary stimulus to the likes of which we've never seen. I mean, hell, in 2020, the number of US dollars circulating increased by 25%, and that's in a single year, which is pretty mind-boggling. Still think many folks haven't wrapped their heads around the implications of that. And then if you look to the crypto argument, I feel like that comparison, at least in today's environment, is apples and oranges. Gold is a security, is a risk-off asset. It's a store of value, and it belongs in the part of your portfolio that's defensive. And in my estimation, this is physical gold we're talking about here. So it's a good complement to your cash or bond positions, what have you. We've been in a risk-on period, so it makes sense why there's been this pullback, but that will change. Markets move in cycles, and I think we'll see gold rise again from that perspective. And Bitcoin's a lot of folks are calling it a store of value, but I mean, any asset that's quadrupled in the course of 12 months, I don't think can reasonably be called that. So I reject that comparison.
Yep. It sort of calls into question this idea of chasing momentum or chasing market segments that seem to be appreciating rather than looking too long term. And you think back to the GameStop and then the sort of silver shorting activity in the Reddit investors, and how sort of irregular this is, but also shows different moves in the retail community indeed. And how does that sort of conflict with the mentality of where a gold equities or a silver equities investor should be thinking?
Well, I mean, there is narrative out there, right? Especially around the silver squeeze and the excitement we've seen on Reddit chat boards there over the past 90 to 120 days. From my perspective, I do try to steer clear of the narrative-driven stories to a large extent, and focus on companies where I think I can back well-qualified, previously successful, honest management team at a somewhat reasonable price, and seek clear catalysts in the calendar that could drive further value from that point forward. So I think it's easy to get wrapped up in the narrative. Whether you're talking more broadly in the markets, that's definitely the flavor with these meme stocks, but also within the resource space in general, beyond precious metals, you see a lot of folks at the moment trying to chase the hottest commodity of the month. And whether that's rare earth metals or uranium or what have you. I think it's okay to have exposure to these different metals in your portfolio, but you want to have a fundamental investment thesis for why this company is undervalued, or why there's a possibility to create value even at flat metal prices. that's the way I go about business. Maybe it's a little bit more conservative, but I'd rather be surprised to the upside from positive metal prices and not bet on outrageous increases over certain time frames.
Yep, absolutely. Excellent. Chris Mancini, now, could I ask your take on some of the macro factors at play here? And then also, is the gold story still as compelling despite this recent pullback? Are you in agreement with the other panelists?
Yeah, I think that what's happening now is that the market is really looking to see whether or not there's going to be inflation after all of this stimulus, because what the market seems to be pricing in now in the gold price is the ability for the Fed to raise interest rates without having an effect on economic growth. So if that does happen, and if the Fed, so if we see very strong economic growth due to a reopening and all the stimulus that's happened, and then the Fed is able to raise rates and we don't see inflation, then I think that the narrative in the market, like, unfortunately, is going to be, well, why would I need gold? The Fed was able to fix this. I think that if that does happen, it'll be short term in nature, because as the Fed does raise rates, as we saw in 2019, when the Fed started to raise rates, the economy did start to tighten up and to slow. So I think that that'll happen again. But I think that's kind of what I think the market is pricing in now into the gold prices, the ability again for the Fed to be able to raise rates without slowing down the economy before we see significant inflation. So I think that could the gold price have another leg down if that happens? Maybe. But again, that'll be short term. I think if we do see inflation, that the gold price is actually going to do well. They're like people, like the market, people are talking about inflation expectations, or the expectation of inflation picking up. If we start to see it, I think that people will look for hedges for that, and they'll buy gold. So that's what I think is going to drive the gold price in the short term. I think long term, I think we all really, fervently believe that long term the gold price is going a lot higher because of everything that's happening now. But but the question is, what is the long term?
Yeah, indeed. And on the equities side, you think we're at the bottom of this correction?
If the gold price, what people say is, could the gold price go down and the gold equity still do well? Like, the answer to that is no. If the gold price goes down, the gold equities will go down. I've been, like I say, people ask me a question. I've been looking at the screen every day for the past 13 years. And when the gold price goes down, the gold equities go down. But that being said, the stocks are very cheap. And if the gold price goes up, and we have a view that the bull market, which we've been in really for the past in gold, which we've been in for the past couple of years, continues, and so if the gold price goes, say, from 1,700 now back up to the $1,900 range, and there's a view that, well, wait a second, this bull market is continuing, the gold equities will do extremely well because they are very cheap. They'll be even cheaper, obviously, at a higher gold price, generating lots of free cash flow, paying dividends. Dividends will be increasing again. So I think that's the view on the gold equities, is that they are very cheap right now. And if the gold price, if we do get this environment where we see some inflation, and the gold price runs again, and the bull market is kind of what is sustained, then the gold equities will do very, very well.
Certainly. And just comparing it to global equities, do you think that that's most global equities, the tech stocks, things like Tesla's price, these are inflated at the moment, and that's got to come down a bit, and that could in turn be quite favorable for the mining tier?
I mean, I don't really think so. I mean, I think what's interesting is that they're both kind of like these. Not Tesla specifically, but the tech stocks generally, I think, have recently been correlated to interest rates along with gold. So as we've seen interest rates rise, the tech stocks have come down, and we've also seen gold come down and gold equities come down. And that's because, the market is kind of discounting, kind of these, when they look at the growth stocks, they're discounting their, future revenue growth back to today using low rates. And so there's all this kind of play there regarding the tech stocks. So I don't think the tech stocks are like taking interest away from gold necessarily. In the short term, again, it seems like it's kind of it's a play where it's a play on rates, but not a play on inflation. Do you know what I mean? So it's like so I think that they're kind of separate. I think that we could see a scenario though in which we see inflation and rates start to rise, and tech stocks do poorly in that scenario because rates are rising, but gold does well in that scenario because we see inflation. You see what I mean? So it's I wouldn't say that we have to see tech stocks decline for gold to go up, or the tech stocks declining will be just broadly, good for gold. It depends on the circumstances or the reasons behind tech stocks declining.
Chris, Ritchie, could I bring you in? And I don't want to pin you down on any sort of market outlook predictions if you don't want to. But what's the view from the mine operator here? Are you just focusing on the projects and the work and delivering your value there without keeping too much of an eye on the silver price, for instance? Obviously, it's good to have the wind in your sails with regards to silver price, but this isn't something that you use entirely to talk to investors with. What's the view from your side here in terms of operating within this commodities price market?
Yeah, I mean, it's definitely been strange. I have a lot of sympathy for the fund managers. It's been a very, very long time seeing outflows coming to the space and the momentum going to everything else. I mean, so managing money in a world where everyone's patience level is probably about 4 minutes long is very tricky, but cycles are cycles. And we're in one of the most interesting places within the cycle in the last 100 years. If you take commodities on a broad base, relative to the Dow and S&P, commodities haven't been this cheap versus the broader markets in over 100 years. So getting people to change their direction of that capital and the fund flow I pay very close attention to that. I have an interesting chart showing inflation data points relative to PE multiples for the last 100 years. And basically, the lower the inflation rates, the higher the PE multiple. So what's really going to be interesting with that dynamic today, as well as what's going on in the market. I mean, Matt said it, he stole my thunder a little bit, that you've seen the US dollars being printed are up 25% this year, or last year, sorry. It hasn't slowed down this year, but velocity is at, I don't know how long, but it's extremely low levels relative to history. So yes, the roaring 20s, if the economy comes back, that velocity combined with, higher quantities of capital is going to have an impact. At the same time, what happens if you stop the stimulus, right? Everyone's been living off this stimulus, not just through COVID. They've been living off this stimulus since the financial crisis. So I have the luxury of having a longer time horizon, I think, when we plan things out. But again, that chart about the PE multiples and inflation rates, the higher inflation rates go, the PE multiples come down. And again, I go back to the fact that, we've seen outflows in this sector for probably a decade or so. We've seen blips, obviously, that have been supportive. But if we start to see a really, really small sector getting little bits of inflows coming back in and momentum starts to pick up, all combined with, a really nice tailwind where all the data points are supportive, yeah, that fund flow dynamic and the Reddit memes and whatnot, I think can really, really move stocks. But, as Coille said, the producers, people in our shoes, again, not we're producers yet, but we've had to show tremendous discipline to manage through the down market. When we talk about portfolio attribution and what we can do, it's not just about what, who's got sensitivity to the gold and silver price on the way up. who can navigate down markets well. Some people don't like it when I speak this way, but I always talk about who does well at $1,500 gold, $1,400 gold, who does well at $15 silver, who can still have free cash flow, because we have to manage through 10, 20-year time horizons. You're not buying assets that are extremely high cost because you're betting your company on $40 silver. So it just doesn't work that way. So for us, we look at that fund flow as a really interesting tailwind. And if it happens in 3 years, 2 years, or 1 year, that store of capital conversation is fascinating. I mean, real estate, we all remember what happened when COVID first hit. We had the luxury of doing a bought deal the day the pandemic was announced, and the market just totally threw up all over the world. Real estate was crashing. Everyone thought it was over. And all of a sudden, like, now we're at close to near all-time highs. And I think everyone's just sort of accepted that this is normal. I think there's a degree of complacency that I'm not sure how it's factored into prices in the market. So I think, yeah, for our standpoint, I think if things go a little bit sideways or down, as well as the inflationary tailwinds, it's all supportive for this sector that's been completely underloved for quite some time.
Yep. Excellent. I just wanted to, oh, please, yeah, jump in.
I just say, I think the fund flow point is really important. I mean, throughout 2020 and 2019, we saw outflows from, the GDX and GDXJ, and yet, gold hit all-time highs. And it really doesn't take a lot to have, a small shift in sort of investor asset allocation to move the gold space. So, if you do see tech stocks or whatever, I mean, some people sort of, reevaluating where they're allocating capital, like it can move the gold story very quickly in the right direction.
Yep.
I think we navigate where we try to, we're going to be speaking to our downside protection for quite some time and how to manage cycles. And hopefully we can be a name within portfolios that you don't have to sweat about as much if the market isn't cooperating in the positive side for quite some time. Because again, if you go another 5 years of negative prices, there's a whole lot of supply and reserves that are going to be depleted, and companies are going to be running out, and there's going to be need for consolidation. There's going to be need for growth. And as numerous of our panelists have talked about, there's been a return of capital focus. There's been a return of discipline focus. So again, there's going to be a big shift in how are companies able to sustain 5, 10, 20-year periods of time in good markets and bad markets. And I think there's a different sort of audience in terms of there's stuff that's going to be really, really fun if gold and silver is doing well, and there's going to be businesses that you're going to be able to have larger positions in those because they can navigate both cycles.
Yeah. So coming back to that fund flow point, is it right to think that the generalist interest isn't coming back then in any pockets of commodities, metals, or indeed in precious metals? Usually, certainly on the physical side, gold is a big part of any big fund's portfolio. Is anyone on the fund management side getting new calls from generalist investors, big pension funds starting to dip their toe back into precious metals again?
I can jump in quickly here. I mean, I will say it's a bit funny. Go back to last summer, and I had multiple partners from within the MJG fund as well as folks externally saying, "Hey Matt, why isn't this a full precious metal focused fund? You guys should be all in on gold and silver," because we had just seen 4 or 5 months of very sustained growth, both in prices and equities. And now it's totally flipped on its head. Here we are 7 months later, and folks are saying, "Oh, are you going to launch a battery metal focused fund? You need to go all in on nickel and the rare earths and cobalt and copper." And it's just this, it's the way this industry works. And I think this cycle has played out. Obviously there's been twists and turns the whole way, but from what we've seen from the COVID bust in March of last year, is precious metals leading, and now the rest of the commodity complex catching up. And I don't think that's too bizarre of a phenomenon in terms of what we've seen in past cycles. And it stands to reason that at some point here, this consolidation phase amongst the precious metal equities will come to an end, and we'll commence our next leg higher. So again, as I alluded to in a previous answer, there is that temptation to chase the flavor of the month. I absolutely envision that we will see inflows at some point here into precious metals equities specifically. But as many of these other panelists, including Chris M, have mentioned, you need the actual physical prices to start moving upwards realistically for that to happen. And in the meantime, it's important to invest in high conviction stories so that you can hold as much value as possible if prices remain soft. And also stories that you have that high conviction in that you're not going to get shaken out of if things stay ugly for another 6 or 9 months. So I agree with Chris Ritchie entirely that these are the kind of environments to focus on quality, focus on those top tier assets, not to toot SilverCrest's horn, but their project makes good money if the silver price fell in half, believe it or not. And there's not many other development stage stories out there that can make a similar claim. Maybe Adriatic Metals comes to mind with the Rupica project in Bosnia, but most of these silver projects that you see out there being promoted really need $30 plus silver to ever get to a production decision down the line.
Yeah, well, let's move on to that then. Where is the panel seeing value or these high conviction stocks? And when you do take the tougher economic overlaying conditions, is it just the development stories, the producers that are going to get the love and going to get the attention, or is now actually quite a good time for some of the earlier stage as well? Let's go around and get everyone's view on where the sentiment is now within the different tiers. Peter, could I bring back in perhaps?
Yeah, I mean, I don't disagree with Coille that the producers actually look quite cheap here. And so you can make the argument that a lot of those names the risk reward is pretty good because the current pricing and the cash flow generation that has are supportive of those names. That being said, I still believe that a lot of the smaller names, the development and the exploration names are catalyst driven stocks that they're going to be drilling, they're going to produce a lot of good results, assuming you back the right teams and assets. And then on the development story, there's a lot of names that are in the process of building mines and will be coming out with a production into a pretty positive gold tape. So the easier sort of plays are the producers and their cheap valuations. But I'm of the opinion that the better risk reward is to if you move down in market cap, where the funded names that have the ability to create catalysts even in any tape will have the potential to be supportive in a down tape, but also extremely positive in an up tape. The producers will do well, but they also need to look at their production profiles that are they have not supported them in exploration, or they're focused on the dividends and the balance sheets, and they're going to need to look at their production profile to support it with good projects.
Yeah, and what are some of those earlier stage companies that are going to present that really good upside? Then what do they look like to you, or what do you prefer? Is it Canadian gold mining companies, good jurisdiction, good management team, but quite under the radar? Is it Australian?
I mean, there are good assets all over the world. So I don't, it's not one of the things where you specific. I mean, obviously the Canadian market is where the majority of my funds is invested, but that's just the relationships I have. But the Canadian marketplace is a global marketplace. I agree with Matt that Adriatic's a name that looks really good. There's some names like Prime Mining, which is an exploration play in Mexico that looks like they have some pretty good potential. SilverCrest is a development story that I agree with, is that is funded and has the ability to manage through these, the combination of developing an asset plus exploration, this type of thing that we're looking for. So there's a lot of good names throughout the globe, and there's some stuff in Australia. Geopacific is a group that's building a mine that we're invested in that has potential to come out in about a year with the production in a really good tape. So the companies that are moving forward, regardless, the projects look good at all these prices and can have the potential to come out in producing into a good gold tape, have the really good positive re-rate potential.
Yep. And you're broadly happy with the way that they've been progressing over the last sort of 12 months,
Yeah, I think the last 12 months, a lot of these companies were able to raise money and put themselves in a good position to weather the storm, but also create results. And so, the fundamentals for a lot of these companies, whether it's in production or not, are a lot of them look really good. And I'm also looking for names that are supported by, good groups of capital, so that in times of need, they'll be able to raise money and not have to, go to the retail market or really push the envelope and where they can find money. I have a closed-end fund, so I don't have fund flows, and so I have the ability to be a little more relaxed in how I look at the names and patient and help support these names as they grow.
Yep, excellent. Chris, could I just get your insight there? Chris Mancini, sorry. You invest across the tiers. Do you see that there's, now's a good time for looking for that upside potential in the smaller caps? Do you think now's a good time for explorers to raise capital at the moment?
I mean, yeah, I think what's interesting is that even at 1,700 gold, there are a lot of projects which make good economic sense. And so it's not like, the gold price has had a good run over the past couple of years as these projects have been developing. So, I mean, we need to see a slightly better tape, but I think that there are some projects out there which are, which make sense to fund at 1,700. So we can't see the gold price going down, but even if it does stabilize at around this level, say between 17 and 1,800, something like that, there are projects which I think will be funded and are trading at significant discounts to their net asset values once they are funded. So, projects like that include Artemis. There's Osisko Mining. Even there's Troilus. Troilus. Troilus is one of those. I mean, that's more kind of that's more iffy, but it's trading at a meaningful discount to its net asset value. Marathon, I think, is fundable and makes sense. So, and we own SilverCrest, which is funded. So I think that there are these companies that are that do have good projects at the current gold price, which will likely be funded. And as they are funded and are built, I think that valuation discount, that gap will be filled. So I think that there is good value there. I mean, we just need, strong, kind of stomachs. I wish that we were in Peter's shoes and didn't have to worry about inflows and outflows. So it would make it a lot easier to kind of take the longer term view on stocks like those that we do own positions in. But so those positions have to be smaller for us. But there are the bigger companies that are generating lots of free, like an Endeavor, lots of free cash flow from that company. And I don't think the market has realized that yet. So there's a lot of upside in companies like that too, which are diversified producers, which should be generating lots of free cash flow.
Yep. And just focusing on your portfolio. Oh, sorry, go on, Coille.
The last time we had this panel, we sort of talked about M&A and whether we thought there would be a huge amount of M&A. Yeah. And I think what's different sort of in the last 12 months is that the producers do have a lot of accumulated cash on their balance sheet. And it was interesting to watch how quickly the conversation turned to growth. Like, okay, well, you have this, now what are you going to build? And, a lot of these producers don't have a huge pipeline behind them. And the juniors have the benefit of 2 years of drilling. So some of those projects are far enough along that you can see how M&A could happen in this space. And generally, I think M&A in the space is good for everybody because it attracts more capital.
Yeah. So you think that the market's quite nicely poised for that then, or perhaps even a backlog maybe in terms of...
I can see how there's more overlap between producers being willing to, even take a, 10% position in stocks versus end juniors wanting that to happen because potentially, going forward this year, it's not clear what the access to capital is going to be. I mean, there was 770 million raised in Q1, which is a big number, but most of that came in January and not a lot, in March. So, and drilling season is ramping up right now. So, to me, there's just more overlap.
Yep. We've just lost Coille there briefly, but it's a good time to switch on to that M&A point, and I'll put it just back to the panel. We saw some M&A last year, quite a lot stacked in the back end of last year. Chris, you mentioned Endeavour. What does everyone think of some of the M&A that's gone on already? Is this accretive? This is good, healthy levels of M&A. It's not sensational or running away with bad deals. I'll put that to the panel now. Does anyone have a view?
Well, I agree with Chris Mancini. Like the Endeavors of the world and the SSR did transactions that on paper look good, but they haven't had the benefit of good stock appreciation. But they're generating cash, and I think as those deals get digested, they make a lot of sense, and we should get the re-rate that they are expecting. And a lot of in going to talking on Zooms on the conference calls with a lot of these companies, the large caps and the mid caps are still shying away from M&A, at least openly. And I think that'll have to change, and some of them will. When some of these companies start taking those bites, it'll start a flurry of activity that we haven't seen in a while. But that's mainly because the companies, and we've been telling them that they've been a little too conservative in how they're approaching it, and the ones that act the quickest probably will have the best benefit when things start re-rating.
Yep. Okay. Matt, do you have a view on M&A? You want to see activity picking up? Are you in agreement there?
Well, sure. I mean, as an investor in juniors and developers, absolutely, bring it on. But to be fair, I also want this to be a healthy precious metal cycle, and hope that the major producers and the mid tiers as well can wait as long as possible before they go into hog wild phase like we saw in 2010 and 2011, and then had a painful hangover in the years since. So, so far, I think deal quality has made sense in a lot of cases. Looking at a few of these recent deals, a bit of a mixed bag. I mean, names that come to mind would be Grand Colombia's purchase of GoldX in Guyana, First Majestic's purchase of Jarrett Canyon from Merk in Nevada. I thought both of those were curious for various reasons. First Majestic diluting their silver exposure, also moving to a jurisdiction where they haven't made their bread and butter. On the GoldX front at Toroparu, that's more of an optionality play in my mind. Big deposit, a lot of money spent in it, but I don't necessarily see it making it into production in this cycle. So I'll look really good at $3,000 gold if we see it, but I'm a little less impressed at current metal prices. Of some of the other deals, I think Evolution's takeover of Battle North makes sense. I think they've pretty cleverly worked their way into the Red Lake district, and that was a natural add-on. I think they timed their purchase pretty well too. Now that we're a good 6 months kind of into this pullback or consolidation period here, and then there were a couple of deals where I'd say the jury's still very much out. I wasn't expecting GT Gold to go quite at this point in the cycle. Maybe it speaks to Newmont's thirst for a little more copper in the portfolio. We'll see how that one works out for them. And then, going a little farther back, there was Equinox's takeover of Premier, which I think will probably pay dividends for the company. But Equinox has now got its handful with going on 10 major assets here, so they need to make sure that they execute on both fronts. So it'll be interesting to see how this unfolds. As I've said in previous interviews, though, I think we're going to continue to see this M&A activity will probably still be confined to North America or more first world jurisdictions, at least for the time being. A lot of these major miners have technical teams already based in these countries, and they want to avoid the mistakes of the last cycle and really go deep into due diligence. So I think kicking the rocks and site visits are kind of a must. And until you see management teams and technical teams being able to travel to kind of less developed jurisdictions, we'll probably see the lion's share of M&A stay in North America, Australia, and similar jurisdictions.
Yep, absolutely. Okay, great. I wanted to just focus in on silver now, just because we've touched on it, and we've got Chris on the panel as well. Where do silver and silver mining equities sit within the portfolio? Obviously, it can follow gold in terms of when it goes, it'll really see dramatic increases in the price and the share value. How are the investors seeing silver any different within the portfolio because of its industrial applications as well? If you think about silver and things like renewables, for instance, is the added demand as we look at decarbonization, is that adding another layer of appeal or sentiment towards silver mining stocks, for instance? What's the take there?
I have a preference for gold, but I do believe that silver has a place in the portfolio. I think that the industrial demand will create some positive, momentum for silver, and the volatility around silver is always there. I agree with what Matt said that there aren't a lot of really good pure play silver projects out there. SilverCrest is one of them. Aya Gold and Silver in Morocco is another one that's generating cash flow and looks really good. But I agree. The First Majestic was the go-to name on silver, and they're diluting their kind of story by bringing in a gold asset. So I don't focus primarily on looking at specifically silver and where I need to. It's the assets that that are the most important part. And so there aren't very many pure play assets that you can invest in that gives you the exposure that's necessary. And a lot of them are high cost that you don't want to be there if things collapse and it causes problems for the portfolio. So finding the few assets that are there is kind of important. Another, some names like Andean Precious Metals that just came out last week, and that looks that has a producer in Bolivia that looks pretty good too.
Okay. Anyone else on silver? Coille,
I'll say just briefly, just like a little bit touching on the last comment on the M&A and then as well the silver is, again, we're focusing on full cycle economics. I mean, some of the challenges that happened in the last M&A cycle where people focused on growth regardless of return of capital to shareholders, and we all know that's been 25 years or so of negative free cash flow and now that's changing. Now people are trying to make this industry more relevant in the long haul. So I think for just focusing on assets that can survive both cycles, I think that's going to be a bigger focus on M&A. We have two small stories around M&A. I mean, one with SSR, they stepped in very early on us. They were great for our cost of capital. They were very supportive partners all the way through. We have been a very high growth story, and they didn't, at the end of the day, they thought we were a little ahead of the valuation, and then they exited with about a 300% return with, hugs and handshakes. And then they were already in the midst of their other deal too, right? So, I mean, there's partnerships that can happen via an M&A to help companies kind of navigate, their cycles and whatnot. And our other brief story in terms of capital efficiency is, we've bought 3 assets in our little geographic area, and our last M&A was a $2 million purchase of something, right? And getting back to some grassroots things that have some sense that could be near existing infrastructure, that doesn't add scale immediately, but from a capital efficiency, I think the world needs to get back to some of those things. But how do you navigate a $2 million asset all the way through to production with all the capital that needs to be raised? There's not too many success stories in that realm too, right? So it's a very tricky part of that cycle. But I mean, again, I just go back to accessing capital is tricky, and how to navigate through in the juniors is hard. And M&A can be really helpful for the big boys that can pay for that and do that. but the people that can make it through to the other end, yeah, there needs to be some consolidation. I mean, just G&A is way too high in the industry.
Yep, this is something we hear mentioned quite a bit as an investor bugbear or an issue. Just coming back to that capital raising point, and going back to investors and looking for the next investment, Chris. Is there a changing narrative at all now from when you started the project? Are you talking with investors about different attributes of the project that are winning favor? Thinking about the ESG side of what investors are expecting now, and then also what you're expected to do as an operator. And some of those values are going to put you in a sort of higher bracket if you do them well, if you're reporting on them well, versus some of your other mining company peers, for instance.
I would say it's a really interesting dynamic between disclosure and actual risk management and taking advantage of opportunities. I mean, we're a little behind the curve on some of our disclosure. We're still a company that's kind of emerging and kind of growing. But from an actual risk management standpoint, if you look at the various buckets, we've been accident free for about a year and a half. We've created a whole camp for COVID that's safer than Canada to be on site there. Mining gets a bit of a bad rap in Mexico. You only consume 4% of the water, and you're the only industry that actually permits your water and pays for it. Agriculture 77%. But I mean, there's the focus on mining versus other industries. So the whole disclosure aspect is great. It's going to take a while to evolve and get away from some of the greenwashing aspects associated with it. But I'd love to see the disclosure get to, okay, how are individuals, performing in their households on ESG metrics? And is that going to come through at some level? So again, globally, it's a great direction. But for us, risk management, is the huge focus. I mean, from a business resilience, we've raised our money. We've been extremely transparent throughout the process. We want a very differentiated share register for cost of capital purposes and, to manage those cycles up and down, efficient use of capital. And we could have done fewer deals than we did. We did a lot of deals because we did smaller deals. The last deal we did was larger. But again, our ability to navigate, the down market is that focus. So I think on the ESG side, I feel for the fund managers, again, with very, very short-term investors at moments and the pressures they have to do to navigate that, and the ESG being a big focus there. But again, there's a very big difference between some of the near-term, headline ESG issues and the actual on-the-ground risk management portions of ESG. And I don't know if that dialogue's that healthy yet.
Yep. Coille, do you have anything to add on the ESG side? How has the conversation maybe changed, or in terms of what you're expecting from your portfolio companies or new companies that you're looking at, for instance?
Well, I think that the conversation, sort of the questions are evolving, and disclosure and willingness to disclose is certainly improving from companies. I think, it's an interesting time in the sense that ESG is something that the mining companies, given where they are and sort of they have to, their impact they can have on local communities, they've always been doing it. It's just, I think it looks a little different now, how it's being presented to investors, and the disclosure that they're having to provide looks a little different for investors. So that, the way it's being presented outwardly, I think is a huge improvement. I mean, there's still a huge delta between sort of the guys that are sort of checking the boxes, I would say, as opposed to truly embracing the fact that ESG is a cost of capital and you need to do it and embrace it and manage your projects for the long term. So I think there's a lot of different kind of questions that are happening. I mean, it's still incredibly hard to, you pull up, there's many different providers for ESG scores, and the same company for two different, providers can look very different, and it's the same company. So that's hard to reconcile as just a generalist. then there's just things you're never going to know unless you actually go to the asset to see, is the community truly happy? I mean, yes, they can tell you, oh yeah, something went well, but you don't really know that until you actually go there and see it. But I think companies in general are understanding that this is something they need to start providing, but there's still a long way to go in terms of what's the right way to disclose it for all companies, because everyone's not taking the same approach, and there's a lot of different providers out there that are requesting different things.
Yeah, so it's progress, but fragmented nonetheless. Is there anything you particularly within your fund you think, gosh, I wish I had more disclosure on this, or maybe it's the narrative of bringing jobs to a community is very well understood. Mining talks that up very well and does it very well, but maybe they're not. Maybe the environmental side at the junior end isn't picked up on as much because they're not producing mines yet, for instance.
I think it differs on sort of what level of development they are. If they're exploration companies, obviously focusing on, well, really all three E, S, and G is really important. I mean, as companies mature, I'm interested more on disclosure on governance. I think that it's really hard to get a sense of governance for seniors, and it's really important. Sort of how boards conduct businesses. A huge thing I wish I understood more and they would disclose more.
Yeah. Okay. Could I throw it back to the other panelists? Are you in agreement that governance is perhaps lacking somewhat in disclosure or in general across the junior tier? Or is there another area that could be improved on, or are things pretty good and the ESG pendulum's just getting a bit too much attention right now?
I think that governance is the most important of the, well, from a, not the most important, but from a disclosure perspective, I agree with Coille. It's the most important for me, at least. I mean, I think that from a, like the E and the S part of it, when you see some of these reports in terms of why these companies have been put on these lists of like companies that don't do the right thing from an E or an S perspective, knowing the companies well, it just shows that these providers are obviously not doing deep dives into the companies and are trying to provide analysis on thousands and thousands of companies. So they do things like pull press reports and things like that, which don't have the full story. So that's discouraging to see, but it is what it is. I think that but from a governance perspective, it is helpful to sometimes read these reports and to see, like, is a certain board member overboarded? Is he on too many boards? Is a certain board member, what's his relationship to the other board members? Is he on boards with other board members? How long has he been on the board? Has he been on a certain committee for too long? Or he or she obviously been on committee for too long. These are things that are hard to do as an analyst, to like kind of cross-reference different boards, and I guess easier to do from a data analysis perspective for these providers. So that is helpful to understand, to read these reports from a governance perspective, to kind of understand where there might be some red flags or issues.
Mm-hmm. Yeah, Peter, do you have anything? Oh, Matt.
Yeah.
I was just gonna say quickly, Adam, that was interesting. That both Coille and Chris pushed the governance side of things. It probably speaks to the stage of companies that they're largely focusing on. Obviously, governance is tremendously important, so I don't want to skirt over that. But from my perspective, a little bit further upstream, I would say social, at least for some of these earlier stage projects, right out of the gates, that can stop a project, firmly in its tracks. And there's cases of companies not even be able to access the mine site. And environmental, also as well, especially in the early stage of the projects, you can cut corners and you can probably get away with it for some time. But at some point, you're going to have to pay the piper. If that's getting closer towards the pre-feas or feasibility study stage, where you're also waiting on some of your major permits. So I think maybe focusing on governance is a bit of a first world problem for some of these companies. Certainly the bigger operators, it looks like there's a little bit of a pushback from Coille, interested in her take. But I think if you're looking earlier stage, the E and the S is more of my focus.
Yeah. Okay. Anyone else want to put in?
Yeah, I do want to just add that I agree. I mean, I think the mining companies on the E and the S part of it. Part of the reason we do a lot of the site visits we do is you get on the ground. The CEOs and CFOs and the IR guys can have their spiel, but getting on the ground and talking to people, you have a better understanding. On the governance side, I think this sector has a long history of not necessarily being as supportive of shareholders as they need to be. I think they're doing a much better job, and but it's definitely even on the smaller guy side. I think it's something you need to focus on, because we know that having a good overall ESG component is very important to these companies. So, my time at Franklin, I was dealing with a lot of larger companies and still some of the small ones, but now I'm getting in deeper, and part of that whole investment process is making sure that they're doing a good job on the governance side, because you can't, sometimes if you get on the wrong side of governance, it's hard to, just as like it is on environmental and social, it's hard to get out from under a bad governance view. So I think it's across the board. We can all do better.
Yeah, I'd like to add a couple of things, because I was on the sell side for a long time with being on the armchair quarterback, and being on the ground now, it's very different. For example, we built a quarantine camp on site in terms of, from a health and safety perspective. And we had challenges from the community because they were expecting us to be living in the community at the hotels, renting houses, going to restaurants and whatnot. So there was an economic impact that we weren't able to contribute in the same way in the front end. So sometimes they take very different shapes, and then you have a dynamic with the government. When there was a shutdown in Mexico, our press release came out same day as the Mexican government did. We had a lot of internal conversations about, should we shut down ahead of the government? And part of that is, well, you're showing up the government. You're telling them that us coming in from a different country know better than you do. So like managing optics around that. So we kind of waited for the government to shut down, and then we're ready to go with the press release, ready to make sure we could help with the relationship side. But we paid the wages during the shutdown. But there's things like, in Mexico, for example, they used to have a system where a third of the tax revenues would go to the local governments, then a third would go state, and the third would go federal. Well, they've now taken that all to the federal side. So it's almost continuing to transfer more of that. I won't call it a burden. It's more about that community relationship to continue the company stepping in. So that interesting dynamic of, all industries, what's their global footprint within a country as to that relationship. And I use that water example. So it's just a really dynamic. And that's why I hope the dialogue around disclosure continues to evolve, because again, there's, as Peter said, there's the easy spiel. Everyone can have nice photos and do the disclosure. I mean, we got hit by one of the rating agencies because we didn't disclose our greenhouse gas emissions. Well, we're not producing it, right? But if I wanted to play that game, like our assets has a really, really small footprint. So on a per ounce basis, we're going to look fantastic. So, I mean, but that's not really getting at the core of the issue. So I hope, it's going to evolve and it's definitely going in the right direction. But again, I will invite, if you look at all industries, aren't necessarily under the same degree of scrutiny as mining is. And mining's had to do a lot of work for a lot of years to make up for a lot of historic evils. And again, it hasn't found its proper footing across all industries yet.
Is that frustrating, having to sort of jump through the hoops with certain things like, carbon footprint, when it might not be directly tangible to your project? Is it a symptom of, these reporting standards being not inaccurate, but sort of not specified to junior mining yet, not really appropriate?
Well, they're immature, and in this whole conversation's immature, and it's going to evolve. But I mean, our panelists here on the fund side, I mean, that's that fits within their work to sort of go a little bit beyond those kind of surface level reports that they get and get to know the teams and how they perform. So that's hopefully an edge that they'll have. So for us, it's dialogue, right? And you just have to, do the right things and have that dialogue. And people are going to get there. And there's just risks in this business that need to be priced in appropriately. But it's all going to get there, and it's all going in the right direction. And I think the mining industry is actually going to stand up quite well under a really deep microscope if everybody else is put under the same microscope. So it's good that it's going in that direction.
Yep.
I think it's important at this point for, you get an ESG score and understanding how it was, come up with in terms of, right now, I mean, I want to call it a racket, but it's kind of a racket in the sense that you can hire MSCI as your consultant so you're paying your consultant who's then generating your MSCI score. And if you want a better MSCI score, they're going to tell you how to put your information in the format that they want so that you get a better score. But it doesn't mean the company that hasn't hired a consultant is any worse. It's just potentially their data isn't in the right format and they're not going to get the right score. So I think we're still in this evolution of, a score is a score, but there's a lot of variability in sort of understanding that, maybe they didn't hire a consultant, but it doesn't mean that they're not doing the right S or the E or the G. It just, they're further down the evolution pyramid.
Yep, absolutely. It sounds like it needs some refinement there in terms of what translates to, real important issues to report on and how they're done and how they're collated. Okay, well, fantastic. Well, look, we've gone over an hour, and I just want to say thanks everyone for your contribution to this discussion. It seems like we're at a pause, but this is a very positive time nonetheless for the fundamentals of the precious metals and precious metals mining sector. So it's very good to conclude on that note, and I look forward to catching up with you all again some point soon. So thank you very much for joining today.
Thank you for having us.
Thanks.
Thanks,
Thank you.
Thanks, everybody.